Okay, so I wanted to tell you guys that we do have our platinum sponsors from San Sebastian, San Filippo, and they have been a strong sponsors for our chapter. They have provided a lot of great education. So, and they are very busy right now as we speak because of the October 15th deadline, but we want to thank them for all of their supports. And also we have our gold sponsors from First Citizen Bank and also 5 Star Bank. Now, we also have our silver sponsor from Chicago Deferred Exchange Company and Golden Pacific Bank, and as well as our bronze sponsor, BFC, US Bank, Exceed CE, IPX, 1031 Exchange Company, and Rubicon. And also want to remind everybody is that every second Tuesday, we are going to have our chapter meeting. And then also we have our monthly mentoring session on every third Thursday. And of course, this month on October 26th, we have this very special event. Last month, we had partnered up with Miami chapter to talk about our Bay Area commercial real estate market. But this coming October 26th, we are going to be partnering up with FIAPSI, and we're going to be sharing our Bay Area real estate market with Dr. Larry Souza. And he, as a lot of you know, that he is an economist. He's going to share with us a lot of statistics, but this event is going to be featuring all the way to Brazil, Asia, everywhere globally. So we're going to have a really large audience we're going to educate them about our Bay Area real estate market. And also we're going to have some networking events going on afterwards as well. So be sure to stay tuned with us on Facebook, LinkedIn, and also YouTube channel. All right. So I'm not going to talk too much more because today we have so many questions for our panelists today. And I know this is going to be a bit, I know you guys all have a lot of questions too. So I really want to encourage everybody to use that Q&A button at the bottom if you have any questions, because we want to leave the chat box for chatting. It's a little bit harder to keep track of all the questions. So if you can just use the Q&A box to ask your questions, and I'll try to get through that when I see them. Now, let me see. Let me go ahead and introduce our panelists today. All right. So today we have Aaron Frederick. I think a lot of you guys know who Aaron Frederick is from Colliers. I had a pleasure to work with him and his team in the past transactions. And he is a top broker in our area, and he has been so tremendous. I keep joking around with him saying that he has all the listings in the Bay Area, but truly he does so much business. And he's an executive vice president in the Sacramento office and a part of the commercial real estate industry for over 23 years, while specializing in multifamily property since 2002. Aaron has been a market leader nearly every year since he began in the industry, with recognition from Colliers, ACRE, and the Sacramento Business Journal. Aaron is a strong believer in community education around the industry, with an annual apartment market forum, plus a supporter of numerous community activities. And his clients are looking for a long-term plan for retirement, partnerships, family operators wanting a secondary source of income, and REITs expanding into new markets. So welcome, Aaron.
Thank you very much. Appreciate it.
Thank you. And our second panelist is Joshua Howard from California Apartment Association. So Joshua leads the association's local public affairs strategy, government advocacy, community relations, and political action programs throughout California. Before joining CAA, he served as vice president of public policy and communications for the San Jose Silicon Valley Chamber of Commerce, and as a senior aide to a former San Jose City Council member. Howard is a registered lobbyist in several Silicon Valley cities as well. Thank you so much, Joshua, for being here. I think we're going to have a lot of questions for you regarding all these regulations in California.
Thank you, Helen. It's great to be here.
Yep. And lastly, of course, we have Marco Cugia. And Marco, he is an associate director of market analytics at CoStar Group. He's currently working within the analytics team and is responsible for analyzing commercial real estate trends and maintaining market reports for the San Francisco Bay Area. Marco regularly speaks at industry events discussing current economic and real estate findings. And prior to joining CoStar in 2018, Marco worked for 7 years in real estate appraisal and valuation, primarily focused on assets located in the 9-county Bay Area. Welcome, Marco.
Thanks for having me. Appreciate it.
We have a very strong team of panelists here today. And I'm going to start my questions with Aaron Frederick, because as the top broker in the area, there are a lot of, and I'm also a real estate broker in this area. We do some multifamily deals, and my company, we're focusing on helping our clients building from 1 to 4 units to multifamily. Now, one question that I want to ask on behalf of a lot of real estate brokers here, with your accomplishment here in the Northern California multifamily industry, what kind of advice would you give to agents who just started in this business?
Well, I think that's a great question that oftentimes can sometimes be glossed over by just, kind of the X's and the O's of the business, rather than really the primary component, which I truly believe is, as you said earlier, making reference to your monthly mentorship program. I believe anybody who wants to be in this industry, the first and foremost thing you want to do is look at who are those in the marketplace, who has, a good reputation, who has, respect within their community, who is very actively engaged, has a healthy reputation amongst other brokers, as well as owners and operators, and finding somebody who can help mentor you, willing, as they say, take you kind of under their wing, so that way they're willing to, again, sow into you the things they've learned in their years of experience, and being able to pay that kind of forward, which I know if you find somebody who, is looking longer term, such as myself. I mean, I've got Matt Sorrow and Ahmed Camille that work with me, and individuals who years ago approached me, Matt multiple years ago, Ahmed just over, about 2 years ago, and, kind of said, hey, we're looking for somebody who has a good reputation in the community, who's willing to go out and really look long-term, because I think the key is, when you're in this business, is to not just be a transactional operated individual. You do that, then you're really just a selfish entity looking for a paycheck, rather than somebody who's saying, hey, this isn't just about me. If you do the right thing by advising your clients, servicing your clients, helping them with their long-term goals and their needs, then ultimately transactions become a byproduct of what are those relationships that you're sowing into, giving them, advice on how to maximize their portfolio, how to make sure they're optimizing cash flow during the ownership period, and then giving them ideas about timing depending on what their goals and strategies are. So I would tell anybody who's new in the business that really the key thing would be to, find somebody who is, willing to, carve a little time out to mentor and coach you, and explain to you some of just the key fundamentals, because really all the transactional process in and of itself, you'll learn by going through the motions, but you really want somebody who has kind of a higher level thinking to help guide and lead you. And, it may take a little while to, gain their attention, gain their interest. I'll use, Ahmed as a great example. I mean, called me, emailed me, and I'm a busy person, didn't respond. But as a young man, he literally then showed up in my office and said, hi, I would like to meet Aaron Frederick. I'm like, okay, well, this guy shows he's ambitious. He's got drive. He's got a desire to really, find somebody to help lead him. I came well recommended from other brokers within the community who, although they didn't specialize in multifamily, had seen the track record and career I had. So I would say, finding a mentor is, one of the most critical components, whether you're in real estate or any other area in your life. If you want to excel in something you've not done, find somebody who's doing well in that area and has a good reputation in the community.
Oh, I think that's a really, really great advice. I have to agree with you on that. Not only you have to be a top broker in the area just because you're number one, number two, but if you got to have good reputation as well, because whatever you do, honestly, multifamily industry is pretty small in this vast area of Bay Area. However, if you're not a good broker, pretty much everybody else know about it. So finding a mentor with good reputation is extremely important. And I've told you this before too. We have done deals with one of your associate, Matt Zar, and we had such a great experience, because it is not easy to find great brokers to work with where you feel like you're being inclusive. Now that leads to another question, is that as a female broker myself, I just find it really hard to find any female multifamily brokers. So how can you help or encourage other female brokers who want to come into this industry and, to build a name of themselves and also gain some respect in this industry?
I think that's a great question. And, I'm one of 5 children and I've got 2 sisters, and both of them are very driven women themselves and have become leaders in their industries in other parts of the United States. And I think a lot of it, again, is not looking at yourself as whether, again, you're, a woman or a man. If you go out and you treat people right, you serve them right, you're willing to have diligence, perseverance, you're willing to, again, continue to come in with character integrity, you're going to be able to, again, develop that respect within the community. And I think in some ways, women can be a little bit softer in life, in some cases, better listeners than us men, who were frequently just like, oh, how do we solve a problem? Rather than realizing sometimes it's not about solving a problem, it's just about understanding a circumstance and helping lead a client to coming to a conclusion of what they want to do with their own business for the long term of their own personal goals, because they can truly, at the end of the day, be the only one who defines what they want their future to look like. So for women who want to excel in the industry, I would say you just do what any other person would do. You go out there and you just get in front of clients, you continue to connect with people, you continue to serve people. I mean, I spent a lot of time doing, I wouldn't call it free consulting, but ultimately that's what it is, where I spent a lot of time planting seed for things that may not materialize for a decade. And, I would say you do that whether you're a man or a woman. You go out with the same principle, same fundamental, and you just continue to apply yourself, do what's right for your client. And over time, you will see success. I mean, I've seen women who've excelled in the office industry, women who've excelled in the industrial industry, women who've excelled in the retail industry. And so I think it's just a matter of time before we see other women who say, hey, I would like to excel in the multifamily sector as well. And then it goes back to, partnering with the right mentor who can go ahead and kind of help you understand the framework of what that looks like to be able to build a business and build a platform.
Excellent. And again, for the female brokers to step up, we also need a lot of male partners to support each other as well. It's not something about just, oh, here we are all female brokers, we just stand up for each other. It's really a collaboration of every single person to lift each other up. So thank you so much for saying that. I really appreciate it. Now, I also want to talk to Joshua a little bit, because we have obviously a lot of regulations during this COVID period. And we just have this eviction moratorium expired on September 30th. Can you tell us a little bit more now, what do you see that happens after this eviction moratorium has expired? What are we expecting? And will the landlord really start to evict all these non-paying tenants?
Well, Helen, first of all, thank you very much for the invitation today. And the California Apartment Association is the statewide trade association that represents owners and managers of residential rental property. We have a very diverse membership, ranging from mom and pop owners who have a single family home or a duplex that's sort of their quasi 401k, if you will, to the largest institutional owners in the REITs who invest in California multifamily housing. So our membership is quite diverse. We've been very busy the past 19 months working with state legislators, the governor's office, city council across the state, boards of supervisors on these various COVID-related eviction moratoria, rent deferral ordinances. And what's fascinating is just how much misinformation is out there in the media, and the whole notion that there was this, pending wave of evictions that were going to be filed on October 1st. I think we have to step back and first of all understand the body of these state regulations as well as the local regulations that have been in place since the pandemic almost started. What I would first of all say is, now that we are past what people call the expiration of the statewide moratorium, there are still tenant protections in place for those who are having trouble paying their rent from October through March of next year. In fact, an owner right now just cannot evict a tenant for failure to pay rent between the months of October and March. Before doing so, an owner first has to serve a special 3-day notice to the non-paying tenant, and then they have to apply for emergency rental assistance through the state or local program, depending upon where the unit is located. And only once that rental assistance application is processed and defined, then can the owner move forward with the eviction if they're denied ERAP or the tenant doesn't participate in the rental assistance application, the tenant's portion of it. So that's one piece to keep in mind. The second piece to keep in mind is we're here talking to a group that's probably primarily Oakland and Northern California based operators. Alameda County has its own eviction moratorium that's been in place since June of 2020. And for all intents and purposes is unaffected by what happened in Sacramento. The way the state law was written back in summer of 2020 and the subsequent versions, the Alameda County ordinance was allowed to remain in effect. And although Alameda County purports to require renters repay the deferred rent within 12 months from when the rent became due, there really is little recourse in Alameda County for an owner to collect on that rent from the tenant. So we encourage all owners in Alameda County to apply, whether you're in Oakland to the Oakland program, Fremont to the Fremont program, or outside of those two cities to the county program, to try to get as much rental assistance as you can if the tenant household qualifies. We're now recognizing that the situation that was on the ground in Alameda in June of 2020 when this ordinance was adopted, that pretty much said there will be no evictions unless it's for health, safety, or to comply with a government order. Times have changed. We have a vaccine. We have close to 80% of Alameda County residents are vaccinated. Unemployment in Alameda is less than 7%. It's closer to the high fives, low sixes, where it was in the double digits back in June of 2020. Schools are reopened, so parents are no longer having to stay home to help their kids who are homeschooling or distance learning. So all the factors that were in place in June of 2020 when the Alameda Board of Supervisors adopted these tenant protections have all changed. And so now it's really time, and CAA last week began a process calling on the Board of Supervisors to rescind the local moratorium because we have these statewide protections in place. So I'll send to you, Helen, to send to your members some of the work we're doing in Alameda, but the bottom line is there's still tenant protections in place across the state, especially for the rent that comes due between October and March. And in Alameda County, really it's the status quo continues because of the local ordinance that's in effect.
Well, yeah, I mean, speaking of the rent relief program, California has dedicated $5.2 billion in the federal funding for the pandemic rent relief. But so far, when I looked at the numbers on Friday, only 13.8%, which is $720 million, has been funded. So, I mean, what is the holdup? I mean, are people not applying for them?
Well, there's probably 10 different ways we can answer that question, Helen, depending upon how you look at this program. We first have to recognize that the emergency rental assistance dollars that are being made available in California come from the federal government. And when the US Department of Treasury released those dollars to the various states, there were some significant conditions that were layered on from the federal government. Number one, the tenants who receive these dollars have to make below 80% of the area median income. So it's limiting the dollars to the middle and lower income families who rent in California and across the country. So there's an income qualification component. Second, the landlord and the tenant both have to apply. So when the landlord applies, the program will send notification to the tenant household, and the tenant then has to do their part. And in the beginning, when this program first launched earlier this year, the tenant portion was 35 pages of documentation alone. So it's a lot of work, a lot of paperwork to get through this program. Luckily, there's been a lot of streamlining that's taken place. The other component is, as I mentioned, there's different local programs. So Alameda County administers its program for the state and the county. Fremont has its own program. Oakland has its own program. San Jose had its own program. What some of these cities have come to realize is the level of paperwork that's required, the processing time was sort of, I don't want to say overwhelming, but there was such high demand that some of these local programs like San Jose and the city and county of San Francisco turned over and unwound their local program and turned it over to the state because they realized they just didn't have the local capacity to process all these local applications. So there's high demand for the program, but the reality is we need to make sure that both the landlord and the tenant do their part, complete the application, and that will ensure that it gets done quicker. The other challenge, what we're finding, is Alameda County is giving priority in processing applications from tenant households who make below, I think it's 50% of the area median income. So there are some owners who actually have tenants who make between 50 and 80% AMI, applied in March or April of this year, and they're still waiting to hear from Alameda County's program whether or not they're going to get paid, because the county's prioritizing those at the lower end of that income qualification band. So there's a lot of cooperation that needs to happen between the two parties. There's a lot of work that the government agencies need to do. And we're hearing that, especially in Alameda County, that there's efforts underway right now to hire more individuals to help process these applications to get them done quicker.
Well, I think that's the part. It's like so many people don't really understand how to file for these rent relief program, and some of the landlords obviously stuck with tenants not paying, and then tenants don't really know where to get the money. There's just a lot of confusion with just like what you're saying, 35 pages
Right.
of application, and it's not easy to get through for a normal average person. Now, because of all these regulations, COVID pandemic is so unprecedented. I want to ask Marco, maybe since you're the number person, you provide a lot of data. I am wondering if you, in the last 18 months, do you notice a significant buyers and sellers change in the pricing or selling expectation on the market, like the supply and demand? What do you see on the market in terms of based on your data?
Yeah, so typically during recessions, you'll see transactions come way down and there'll be price pressure. We've seen overall volume hold up relatively well. It's actually the number of transactions that's decreased significantly. So there's still been some high profile deals in some institutional properties, maybe really well located assets, but the number of transactions taking place is down significantly. And we do typically see that during recessions. You saw it in 2008 and 2009, but that's really the biggest difference, is that not a lot's trading hands. The stuff that is trading, the price points have held up well and rents have come back this year. So I think things are relatively healthy still. But it's really difficult to know kind of the full picture when there's, the number of transactions taking place has decreased to the level that it has. We're tracking a little bit higher this year, so things have been getting better. But we're really right on, just slightly over last year's pace, which was, the lowest we'd seen in a decade plus in terms of the number of transactions taking place.
That's interesting. And to be honest, during the beginning of this pandemic, I was a little bit worried about the multifamily market, if it's going to go down, but then literally within just a few months, 3 months, and all these buyers are coming back. Now, Aaron, do you see the same situation? Do you see any fluctuations in terms of demand and also supply of the inventories on the market?
Yeah, I think one of the key things was, back when the whole shelter in place thing took place, started back in 2020. I mean, all of us who were in all sectors of industries just said, oh my gosh, look out, this is a train going off the cliff and we're all probably in deep doo-doo. And so, of course, literally it probably took almost about 3-4 months for everybody just to kind of say, time out, let's wait to see what the world does. And fortunately for the multifamily sector, we saw, of course, some of the exodus out of the Bay Area that caused what was occupancies to drop to some of the lowest we've seen historically in the Bay Area. Sacramento, on the other side, was a huge benefiter of that migration, which was already something that was happening, but kind of like some of us joked earlier before this, that it put all this stuff on steroids. And you started seeing people coming into the Central Valley that now could work remotely, work from a distance. And we found out that a majority of the individuals who up front were like, okay, everybody's going to quit paying rent and nobody's going to continue to funnel what are necessary to pay your landlord's bills, for whether it's just operating costs or mortgage payments. And once we saw that a majority of the residents actually did the right thing and used their unemployment funds if they needed, and or were still working to cover their apartment expenses or their rent, a lot of the buyers then got back into the market realizing, okay, well, hey, we didn't fall off a cliff. We're actually just seeing a mild paradigm shift. In the Bay Area, of course, with the drop in occupancy, drop in rental rates, that did have an impact on price per units. It did have an impact on cap rates, but this year we're seeing all that rebounding in the market as occupancies are picking back up out in the Bay Area more rapidly, kind of in the Oakland area and San Jose relative to San Francisco. But again, Sacramento has continued to be one of the best performing of all three, where, rents have continued to escalate. Occupancies are still some of the top in the country. Price per units are still at record points. Cap rates are at an all-time low. But again, that's, just indicative of the strength of Northern California as a multifamily sector. And so, yeah, not only are we seeing a shortage of supply, because you've got some investors who just don't know where do they want to go with their money if they're going to do an exchange anyways. But there's a lot of exchange money coming in that is the driver for why we're still seeing cap rates remain low. Interest rates are still significantly low. So overall, we still have very strong market fundamentals that, literally a year and a half ago, we would have said all cards are off the table. But that's not proven to be the case. So it's been exciting for us here in Northern California to realize that the overarching fundamentals have still remained strong. And, buyers are back, looking at assets on a long-term component, which was really what real estate always was previously. And so that's still, benefiting, landlords that are in a transactional, exchange. Some people moving money out of the state, other moving from the Bay to Sacramento, and others I've seen who are in the Central Valley who are now buying stuff in the Bay Area because they're like, wow, I can get a price point on those projects that I would have never expected 2 years ago, and I'm in a long-term place, so I want to buy in San Francisco now, where I can get some relative opportunity comparative to what it was pre the kind of COVID, shelter-in-place element.
Yeah, absolutely. And speaking of like cap rates and rental rates, I'm wondering, Marco, do you have any data that you can show us in terms of like where the cap rate is going to go in the next couple of years, and also the rental rates? What has been going on with the rental rates in the Bay Area?
Yeah, I got one slide that I think would be good because it has most of the Northern California markets on it in terms of rent. Here, let me just share my screen real quick.
Awesome. And we are all CCIM here, and everybody loves data and charts.
So let me know if you guys can see this chart here. Is that up?
Yep, it's up.
Okay, perfect. Yeah. So this is really, this is what we're looking at is our daily asking rent series. So it's really powered by apartments.com. So we're getting tons of properties that are on live feeds. So in most of these markets like East Bay, San Francisco, and San Jose, there's tens of thousands of rent observations daily that are flowing into these time series data sets. Sacramento would be something similar, a little bit smaller in your smaller markets. And then what I did was I indexed this to January of 2020. This really shows a nice picture of where the population flow went last year, how it performed during the pandemic, how the recovery's gone in the kind of inner core East Bay, which is really where the stress was in terms of people leaving. Obviously, very expensive markets. If you now have the ability to work from home, why am I going to pay exorbitant rents in Palo Alto if I can go somewhere else? So obviously, Sacramento's taken off. That's really remained hot. I think one of the interesting points here too to note is that while we've seen the recovery in San Francisco, San Jose, the East Bay, we haven't really seen a slowdown up in the North Bay and Sacramento and kind of maybe even getting into the Valley markets. So there's been really almost a net gain across the board here in terms of demand where, yes, there was flow out to these other markets, but really all the markets are still performing well. A little bit of a slowdown recently in terms of San Jose and San Francisco. I think a lot of that has to do probably with Delta pushing back return to office timelines further. So that'd be probably one explanation there. Another one is we could be seeing a return to seasonality. Prior to 2020, we would typically see rents peak mid-summer months and then kind of actually taper down through the end of the year in kind of a cyclical leasing cycle. So we might be seeing a little bit of that in the data set here as well. But yeah, overall, this type of dynamic real-time data, this has really been our leading indicator in terms of like where demand is flowing. So all these properties are on, rent, maximizing their rent potential. So they're changing their rents constantly. And so, demand really pushes these rents is kind of what we've seen over the past year. It's been a great leading indicator. It's been really interesting to see this year, these other markets like even Modesto, Stockton, and Santa Cruz continue to take off. You can really see where people are locating, how remote working is kind of changing the demand patterns in the Bay Area, and still some uncertain questions in terms of where does that look like long-term as we move forward. Certainly, most people are kind of getting locked in a renter pool where the housing market's taken off. So we have a ton of apartment demand, just where that demand's going might be changing a little bit from where it's been, given like longer term historical trends.
This is really interesting because as you see, I mean, obviously we kind of expected the San Francisco, San Jose area, we have this downturn, but it has been improving. And then as what we thought we're very optimistic about this whole COVID-19 is getting better around July. And then they were talking about going back to work September, October. So that's when the rent rates kind of going back up and vacancy ratio also coming back down. But when Delta variant came up, and then all of a sudden you see this coming back down again. But Stockton, we have a lot of clients looking in Stockton also. And I know, Aaron, you guys do quite a few up there as well in Stockton and Sacramento. Rent rates have been so steady and it's been so competitive. But one thing I actually didn't hear a lot was Santa Cruz. Santa Cruz, oh my goodness, look at that trend line. It just kept going up so much. And I mean, Aaron, do you see a lot of people interested in buying in Santa Cruz these days?
Well, we are seeing a trend of, as individuals were leaving San Francisco, San Jose, migrating down into Santa Cruz. Napa right now is, blowing up in regards to demand for housing. But when you look at those as what would be multifamily rental markets, you don't really have a lot of multifamily rental housing in Santa Cruz or Napa for that matter. I mean, you have some, but it's a very small fraction relative to the major cities. And so, of course, that, helps them drive rental rates at a much higher rate in some instances than what you might see in larger markets like San Francisco, San Jose, Sacramento. But I think one of the things that is notable is now we're into the fall season. A lot of parents who are moving and shifting over the summertime wanted to be sure their young kids were back into school somewhere. And so, of course, that's kind of that seasonal component that was just made reference to, is that, you'll see a little bit of a softening in the average rental rates through the end of the year, which is very common. Just because, again, people needing to be settled, kids back in school now, rather than, them doing a lot of the remote learning. But I think, with that migration from, people exiting, major cities there in the Bay Area, that's been a big catalyst. But not a lot of sales activity in Santa Cruz or Napa for multifamily apartments just because of a lack of inventory. And we're seeing, again, more folks who've decided, the Bay Area has got, good reset fundamentals right now. And, occupancies in those areas are going to continue to show improvement over the next year to 2 years. We're going to see, occupancy remain strong in the Central Valley. Average rental rates are going to continue to increase across all of Northern California. Some areas will be at, smaller rates than others. In the Bay Area, they took such a massive rent reduction over this last year that, to go from what was, one point, almost a negative 20% rent growth to, at a point where we're starting to see what on a year over year is only, 10 or 15 is actually very favorable, which shows indicator that, probably as we get another 12, 18 months out, that it should at least hopefully start to stabilize and, at least get back to zero. So that way they can create some more normality in the Bay Area, Silicon Valley, where Sacramento and the Central Valley will still just see, occupancies remain strong with a shortage of inventory. Most people can't afford housing, so they're, pushed over into the rental market, which, bodes well for all the landlords in the marketplace.
Well, no, now looking at the rental rates has been recovering. And actually, Joshua, this is a question for you. If a tenant or a landlord had applied for the rent relief program, can they still be evicted now that the eviction moratorium is expired?
Well, that's a really good question, Helen, and it does sort of depend on quite a number of factors. So I would encourage anyone who's facing this situation to first consult with their attorney before moving forward with an eviction. Having said that, generally speaking, as long as the application is pending and all parties have done their required paperwork and the application is in process, there is a general assumption of protection from eviction until the application processes. However, if certain parties don't fulfill their obligations, for instance, if the tenant completely ignores their responsibility to complete their portion, I would encourage an owner to work closely with their attorney, because there could be cause to bring about an action to recover possession of the unit.
Okay. Yeah, I mean, we probably, I don't know, a lot of us probably just heard on the news there's always news constantly talking about landlords coming in trying to evict tenants in California. And recently we have news a new landlord coming in, bought this building, he's broker, an attorney, and then now he's trying to evict all these tenants out of the building, just so that he can raise rent. Landlords can say, oh, I'm coming in to remodel everything. I think sometimes there are a lot of bad landlords out there, but there are also way more good landlords who really actually try to help the tenants, because not every single landlord out there is out there trying to get the most money out. I'm sure, Erin, you talked to a lot of sellers who's been saying that, oh, we're just trying to keep the rents pretty low, just so that our tenants have a place to stay. We're not going to raise rent too much. But by the time when they decide to sell, then the new buyers come in, of course, then they're going to look at it and see how they can increase value on the property by increasing some rents.
Well, I would agree that we're, seeing some owners. There are some owners who go in and have said, hey, we're vacating an apartment building and we're going to go in, remodel, reposition. And candidly, there's some real estate in Northern California that's so dilapidated and so decimated that it needs somebody to go in and fix the real estate if we want to preserve housing in the Sacramento community. I think there's definitely better methods and strategies than just walking in and giving, a 50, 100 unit apartment complex, everybody an eviction notice. I think there's definitely better strategies, but we are in an instance of where the real estate in Northern California, a majority of our housing is in need of maintenance, repair, updating, upkeeping. And that was one of the elements of whereas, a new buyer comes in, says, hey, you know what, I need to put this capital into the building so I can preserve this real estate for the next 10, 20, 30, 40, 50 years so we have housing available. And I think, one of the challenges now is you've got a lot of landlords who traditionally would have said, hey, this is a great tenant. He pays his rent. I'm just going to leave him alone until he decides to move out. But now that you've got state rent control, city rent control, you have landlords who are now saying, okay, cool. Well, the state tells me I have a 9% rent increase as of August 1st. So here's your 9% increase the state told me you need to get, because I'm not allowed to really operate as a business owner, entrepreneur in the state, and I have to operate under more government restrictions. So I would have left you alone without government regulation, but because now they've imposed this restriction on me, I need to pass this on to you because labor is more expensive today, materials more expensive today. They keep raising your utility costs. They keep raising your insurance costs. And there has to be a way that as a landlord, you can still preserve the real estate. And if you don't have the ability to have cash to preserve, then all of a sudden, we just see all of the multifamily housing, become junky, destroyed, decimated material. So, I feel it's hard for landlords that would have left the resident alone, but now because of state and city mandates, they're like, I have to provide you with this increase because otherwise I have no other mechanisms to still preserve the assets you're living in and keep housing available within the community. And so, I think that's one of the challenges when government gets its hands into, business, when they don't really know what it's like to own or operate an apartment building. So, landlords, they're continuing to do their best, and they've had to realize that, they're being negatively impacted by government restriction instead of doing what they would have done before. You're a great renter. You pay your rent on time. You're quiet. You're non-problem. I might give you a $50, $100, increase periodically just so I can kind of, keep up with my minor adjustments. But now because of restrictions, people are typically pushing the maximum allotment because you don't have a recapture component available. And then when people are moving out, people are just saying, here's the new reset in the market. And if I'm not doing that, you're almost disservicing the tenants in the community, because if they have to move somewhere, they don't understand the new barometer of the market. So you're almost, disservicing them in regards to the reality of inflation, the reality of costs, and not helping them prepare financially for what is, a unit that may have been $1,000. Well, now the market's 1,400. Well, if you haven't helped them keep up, they haven't learned how to manage their own personal finances so that if something happens, they need to move. How do they manage that new adjustment when they were kind of living blinded to the reality of the economy and the marketplace going on around them? So it's definitely created a unique dynamic for not only landlords, but for renters too, who are having to figure out how to adjust and adapt to what's taking place in the market.
Yeah, this, when I first came to this country, I actually lived in Santa Monica during my college years. And it was, of course, Santa Monica is under rent control. And, but my apartment, I still tell this story to my kids, is that all the carpets were sticky to walk around because it's just so old and the landlord would not replace it. And all of our appliances just like from the 70s. Everything was just so old, and it's not insulated well. It's very cold in the wintertime. I mean, that was the kind of condition that we were living in when an apartment building was under rent control and the landlord just refused to do anything to the unit. So I absolutely agree with you. Sometimes like the government regulations cause the landlord not to have these extra money to actually update or upgrade their building and provide a better living condition for the tenants.
I would say a majority of the landlords want to do the right thing and take care of their residents. There are, like anything anywhere in life, there are a few outliers who are people who have bad intention, don't care, could, no interest in the well-being of others. But a majority of all the multifamily owners that I deal with, they want to do the right thing. They want to provide, they want to care, they want to respond, they want to help with maintenance issues. And some of them are, again, then limited due to financial resources, because there are a lot of the people that own apartments in Northern California are the mom and pops. They're not these huge institutions with billions and billions of dollars of portfolios. They're that small business owner who took their life savings and maybe bought a house or a duplex and bought a 10 unit and maybe a 30 unit or a 40 unit through exchanges over a period of time, and, still making a margin, but, again, not having massive amount of money. So I think there's a kind of this misperception that if you own real estate that you're some uber wealthy elitist, which isn't the truth at all. Most of the individuals that we deal with are just hardworking folks who found a way to pinch their pennies to be able to take that next step in their American dream of owning something that may allow them to have an additional income stream outside of just their job or their small business. And so I think it's unfortunate through the media and sometimes the politicians that, those hardworking folks that are trying to provide housing and using that as a medium as another income kind of get a bad reputation. But if you really take the time to get to know who they are, they want to do the right thing. They want to help their community, as well as then try to provide not only for their livelihood, but for their children and their children's children through being able to take risks and, being willing to kind of put their hiney on the line with all their savings and resources. That, there's other people in the country who don't want to do that. They're, hesitant or, timid about taking those risks. And so, I mean, my hat off to everybody who, is willing to kind of stretch to start doing something outside of just the employment situation that they have, but trying to step into ownership of something that they can hopefully build for the future of not only their family, but their children, and hopefully, a third generation, if at all possible, depending how they manage it and the way they operate.
I cannot agree with you more. And then maybe Joshua and Marco, you have this statistics, but what I wanted to share is that the same situation for me, right? Again, I'm an immigrant coming here, didn't have anything, but I did build my financial independence through multifamily investments. And so I know firsthand, I was a tenant as well. I know firsthand how you work hard to build up that portfolio just to gain that financial independence. And our company, we're doing the same thing. It's like, hey, let's help them to buy their first home and then start building up, and then so that they can have a financial security towards their retirement. Now, what you said earlier, it was I thought a lot of people should know is that most of the landlords out there, they are mom and pops landlords. Does any one of you have that statistics? What is the percentage of the landlords out there? They are mom and pops instead of these huge corporations owning these massive portfolios.
Well, I will just tell you this, Helen. I thought I had the number right in front of me, so I'm going to say this is within the margin of error of like plus or minus a couple. There are over 25,000 owners in Alameda County who own fewer than 10 units. So there's 25,000 built 10 or less. So there's quite a few thousand mom and pop owners just in Alameda County alone.
Absolutely. I mean, we work with so many of these smaller, really individual who work very, very hard to make that. And nobody will one day say like, I just want to be a landlord so I can take advantage of tenants. No, they just wanted some security and some investment on their own. And you know what, we also touched on a little bit about the cap rates. I want to say, Marco, do you have statistic regarding what are we looking at in terms of cap rates? Because earlier, Aaron, we talked about before, back then, everybody's making fun of the Bay Area. Oh my gosh, you guys are doing 3% cap. Now, everywhere in the nation, there are a lot of 3 cap, 3.5 cap. So, Marco, do you have any statistics showing us?
Yeah, so our forecast, which is we get our econ data comes from Oxford Economics. We kind of flow that into our model. We have cap rates essentially staying flat, maybe ticking up a little bit over the near term, but that's kind of always been the case, and they keep staying flat or going down. So the market will definitely dictate that. I think the primary reason for that in our forecast too, interest rates are expected to stay low, and then Aaron, you should be able to speak to this maybe even better than me, but there's so much capital that's coming into the market interested in commercial real estate, and multifamily is an extremely attractive asset type, maybe along with industrial in terms of popularity, that pressure is just going to keep cap rates either around the levels they're at, or plus or minus a few basis points here or there. That's kind of our perception. That's kind of what we're seeing in the market, and that's what we have in our forecast as well.
What about Aaron? What's your forecast?
Marco, I would agree with you on that. I mean, you look at multifamily and industrial properties are the #1 product types in the United States of America. Multifamily has become far more predictable in regards to anticipation of what income may be. And as you look at, the office and the retail industries, those are such wild cards right now with unpredictability as to, which businesses in the retail industry are going to survive as everything goes from, brick and mortar to click and order. And then you start looking at what's going on with the office industry as to who's going to work remote, who's going to actually go to an office building. And so how much of that space is relevant? How do you start to even predict or anticipate what, cap rates or yields on some of that stuff would be with so much uncertainty? But, with the multifamily sector, people always, and that's one of the things that led me to be somebody in the multifamily industry. I'm like, well, people are always going to need to live somewhere. And we always have a shortage of housing. So it gives you at least some predictability, whether rents go up or rents come down, at least you typically have some form of rent. And so I foresee that, cap rates are going to continue to, really kind of maintain kind of a level, and in some cases may teeter down just a little, because as Marco pointed out, there's so much capital flush in this country. It's stunning. I mean, when I talk to, the REITs or the institutions, which literally are only, they're probably maybe 5%, 10%. I don't know that statistic, wholeheartedly, but, just looking at the client base of who I'm dealing with on a regular basis, they probably only make up 5 or 10% of the industry, but they're using money from, small individuals who funnel money through them to be able to get a slice of something where maybe they would never get a slice of anything. But those corporations are running very flush with cash flow. And you've got, other mom and pops who, again, have been able to find ways of leveraging their 1031 exchanges to still reposition their portfolios. If they were smart with their money, they were paying down debt over this last many of years. So they've got a healthy amount of equity that they can roll over into another asset, into something larger. I still encourage most people to be very conscious on loan to values, because that's always the danger. And anytime you buy stuff is if you're over leveraged and you see a drop in rents or drop in occupancy, well, that's what happened in 2008, 9, and 10. So, if you can take a healthy amount of equity, reposition in something slightly larger, increase your cash flow, you really better your position. So cap rates are going to probably, for at least this next year, remain level, and in some instances will probably teeter down a little further due to shortage of inventory. But again, low interest rates and fundamentals still being very strong in the multifamily sector.
Yeah, and I know the tertiary market even, who would have thought that Stockton, they're selling at 4 and 4.5 cap nowadays? And that was just kind of like, it blows my mind to see that. But at the same time, they are the one that rental rates have been holding up very strong, and also the occupancy level has been really strong as well. Ernie Ocha, he has a question, is that, do you foresee the new Biden tax plan have a huge impact on multifamily and CRE investing in values? Anyone would like to comment on that? I know he talked about potentially removing the 1031 exchange, but it doesn't look like it's going to happen. But any other Biden tax plan that can affect real estate investing?
I think everybody's tax plan is unique and different. So, there's so many moving parts on a day-to-day basis that if anybody has questions about tax plan impact, go call a CPA, go call your accountant, go sit down with one of those experts, because literally in this last 3, 4, 5 years, there have been so many things that have changed on taxation, regulation, policy, that candidly, even for myself, and I would assume, everybody else as a panelist would say that it's such a moving target from one day to the next, 1 week to the next, that we can't, as an advisor, stay on top of how that is, because everybody's tax situation is distinctly different depending on their tax brackets, their other losses, their other gains, and everything else. That really check in with them. I mean, we all pray that they don't, put a kibosh on the 1031 exchange, because that's just going to hinder more mom and pops from being able to find a way to grow their future. If they start taking away some of, resetting and gains after, what's going on with, passing of assets to family members, if they start taking away some of the resetting on that, that's not going to be healthy for our country. So, I think many of us in the industry just pray that, they'll leave those variables alone that have been beneficial to generational inheritance, as well as those who are still trying to figure out how to build some form of cash flow or wealth by taking a risk. And that's why people come to the United States of America, is that, if we're willing to take a risk, calculated risk, we can do better because we're willing to get out of our comfort zone. And so that's, go call your CPA, tax accountant. Wish I could give you better input on it, but they would be your best resource with all the moving parts coming out of Washington today.
And I mean, this is a great question, because it goes back to Joshua with a California Apartment Association. You guys have been helping, of course, fighting for the landlords, right? And also, of course, tenants as well, in terms of all these regulations in California. Now, because of there's so much regulations in California, we start hearing all these like, oh, California mass exodus, people are moving out. Do you guys see any mass exodus, like what the news is talking about?
Well, I would defer to Marco and Aaron about sort of some of the hard numbers, but if, as Marco showed in his chart, if the rents are continuing to go up, then there's demand for housing in California and those markets that he was sharing with us. So, and then if you continue to look at the news, and there was an article yesterday or over the weekend in the Silicon Valley Business Journal about the number of offers a buyer has to make before they actually are able to land an offer and buy a home. There's clearly demand. However, what's fascinating and something that not a lot of people are aware of, speaking of regulations, Helen, is there's a little known caveat in state law called Penal Code Section 396. And what Penal Code Section 396, it's triggered, and we experienced this through the pandemic, and we continue to experience it today, is whenever a state of emergency is declared by Governor Newsom or by a local municipality, it is PC 396 is triggered, which says that consumer goods and services, the price of those goods and services cannot increase by more than 10% above the pre-emergency level. Rental housing is considered a good and service. So let's just take an example. As we all heard about the horrible oil spill that just occurred off the coast of Orange County. Governor Newsom declared a state of emergency for Orange County. And what that allows, it allows for the state, the federal, the local governments to coordinate mutual assistance, funding to address the emergency. It also triggers Penal Code 396, which puts some price caps on goods and services. Now, all of Orange County is under a temporary, I'm going to call it rent cap, where owners can't raise rents by more than 10% throughout the duration of the emergency that was triggered in response to an oil spill. Now, totally get when a state of emergency is declared for a fire, a flood, or an earthquake, like the fire situation in Northern California. There will be an increase in demand for housing. I don't know how an oil spill increases demand for apartments in Orange County. So that is something that we are grappling with, is how can we make some modifications to Penal Code Section 396 with the state legislature to address the absurdity of some of these artificial price caps that get put in overnight by executive order and remain in place for as long as that emergency declaration is in effect.
Yeah, I mean, I can't emphasize more. That's why we have to work with California Apartment Association, because they are really fighting for us on a lot of these crazy regulations out there. But yeah, I mean, this is also what about Marco and Aaron? Do you guys see any of these California regulations that have caused this whole mass exodus that people are worried about? And then does it change anything regarding people's investment, whether they want to go out of state more and they don't want to stay here? Is it really better off to be out of state because they have better cash flow compared to California?
I mean, in terms of like the population exodus, I think that narrative is pretty overblown. Like the Chronicle had a really good article, and we did some, diving into the data too. But most people who moved around, like out of San Francisco or San Jose, they just moved around the Bay Area. Most people did not leave California. So from that sense, we're just shifting demand around to maybe more or less affordable areas in the Bay Area, but people are still here. It's obviously not good to lose headquarters, but most of these companies are keeping a significant presence in the area. So I think the bigger thing to watch out for is not where they're not where they're changing headquarters for likely tax reasons, but if they're moving their entire operations out, or if large numbers of employees are shifting cities, that would be probably more concerning than some of the moves that hit the headlines recently. It's really following the people. And, most of what we've seen over the past year and a half has just been people shifting around the Bay Area.
Absolutely. How about you, Aaron? Do you see any changes in the demand?
Well, I think one of the things that I heard statistically is that for the first time at the end of last year, we did see a slight population decline in the state of California, but nothing significant in the scope of the magnitude of how many people live in the state. And I think even as we talk about some of these larger corporations who move out of the state of California, that's been going on for 5-10 years as companies look at, hey, how do I find maybe more business friendly environments that maybe have more tax friendly environments for corporations? I mean, that's been going on for a decade at least. And so I think even as we may have a few others that continue to exit and move to Texas or Florida or Colorado, wherever they maybe want to go, I don't think you're going to lose the hype and the buzz of the Silicon Valley. I think it doesn't matter if some of these companies move. You still have the think tank of minds in the Silicon Valley that they're going to still want to be able to collaborate with. They're still going to want to be able to part with. You still have some top educational institutions in Northern California that are drawn on for whether it's tech, agriculture, and a lot of other elements that are just high power resources for Northern California. So you may see companies leaving as we've seen in the past, but you're going to find other new starter companies, other innovative corporations who are going to kind of backfill that void that's still going to maintain and preserve the integrity of the job market as we continue to just move forward. And I think that's always been something that's been going on in Northern California as companies say, hey, well, where do I move my employees so they have more affordable housing because we can't afford to pay them out here? Well, then a new firm comes up with, a new product, a new widget, a new, resource that then, still draws back that think tank. And, for the Bay Area, talking to some folks out there, I mean, once we start, I've heard Apple and Google and Facebook are all planning at one point in time, although they probably would have already done it after Labor Day, as many companies were talking about, but probably in 2022, they'll start saying, hey, some of you need to be back out here in the Silicon Valley again, showing up into the office to make sure we've got this face-to-face collaboration that exists that helps us thrive. I mean, Zoom is great and amazing, and it serves a wonderful platform in today's day and age, but they're going to want to have what is that incubator. That's why they built massive campuses, because it just accumulated a different, thought, discussion, and dialogue to be innovative. So I think we'll still see, as those corporations say, we want you back, whether it's, 1 day a week, 2 days a week, 3 days a week. It'll be interesting to see how that shifts some of the mechanics of, maybe some who've left the area to reemerge back in the Bay Area so that they can still continue to meet their employers' needs for what it is of, a presence in a building rather than just doing everything remotely. So it's going to be a very fascinating element, kind of the biggest human experiment we've probably ever had in my lifetime, at least.
Totally. I can agree with you. I can agree with all of you, on this, because if you look at Apple, just like what you're saying, Google Campus has invested a massive amount of money into these massive campus in North San Jose, and as well as Apple. And was it yesterday that Apple just closed on a few more buildings in Cupertino? And so you see these companies, they are really investing here. However, the news out there is not going to show this. They want to talk about how these mass exodus going out of California and nobody coming back in. Our company works with like residential clients as well, and we are really busy, and we have clients actually moving into the area. We do have clients moving out, don't get me wrong, but we do have clients moving back in. So it is some in and some out. So, but it's 11:03. And I told all of you guys that I wish this is a 2-hour segment, because I have so many more questions I want to ask you guys, but I cannot thank all of you enough to be here and share so much information with us. I think it was super fun, engaging, and very productive. I again, thank you so much for being here. I hope that we can do another segment maybe next year and then see where the market is taking us next year. And so for all those, our audience, thank you for participating today. And don't forget to join us next month. On the second Tuesday of the month, we have our another event. And also every week, just connect with us on social media, on LinkedIn, and on our email marketing, so that we can keep you posted on all of our events. Again, thank you, Marco, Erin, and Joshua today for your information.
Thank you for hosting, Helen. We sure appreciate it.
Yep, thanks for having me.
All right. Goodbye,
Thanks, Doug, for
everybody.
putting all this on. Appreciate it.
No, thank you. Oh, by the way, we're going to share a couple of the slides that Marco have shared with us, so we will be able to share with everyone else. All right. Talk to you later. Bye.